Welcome, everyone, to another episode of Proactive Tax Strategies. I'm Patrice Sikora, and we are happy that you are joining us today. Our host, Ken New, brings more than 25 years of financial industry experience and expertise. Ken began his financial career at John Hancock, but today he is the founder and owner of Pinnacle Financial Wealth Management, a private financial firm dedicated to providing holistic financial management and proactive tax strategies to high net worth individuals, CPAs, fellow advisors, and attorneys. On this podcast, Ken showcases many unique tax mitigation maneuvers and retirement topics. And today, we have a special guest, Mark Miller. Now, Mark has spent over 30 years in the tax and financial services industry, helping his clients grow and protect their wealth. He's worked with hundreds of business owners, physicians, executives, and high net worth clients, cutting their taxes significantly. He helps them grow and protect their business and retirement assets in good times and bad, and preserve long-lasting family legacies. Mark is a best-selling author, having written several books on personal finance. His latest book, The Tax-Free Business Owner, teaches business owners how to zero out their taxes, just like many Fortune 500 firms. But without further ado, Ken New, this show is yours. Over to you.
Thank you, Patrice. Very great intro, as always. Appreciate that. This is our first live broadcast, so we're going to have some fun today. And I'm excited to have everyone on the show. Again, our objective here is to educate on a variety of tax mitigation strategies, tax reduction strategies, but ultimately to maximize financial outcomes. And we like to do that for individuals, high net worth individuals, not necessarily the $10 to $100 million clients, but they can greatly benefit from this type of strategy. But also the accredited investor, $1 million of net worth, maybe even less, can really benefit from these strategies. And I've always said, if you change the way you see things, the things you see will change. And here's the thing, typically we're asking our CPAs and accountants to help us with these tax strategies. And so here's the thing, they're busy doing taxes. They're busy doing audit functions, and very often the lesser known and even some of the more common tax strategies just kind of move on by. And so we're here to talk about those kinds of strategies, and we have a special guest today. His name is Mark Miller, as Patrice said. He is a business consultant to the Hilton family office and the CEO of Hilton Tax and Wealth Advisors. So Mark, tell us a little bit about yourself.
Well, I started in the business. You started with John Hancock years ago. I started with IDS American Express, and I remember coming out of college, and I sold one of the largest retail life insurance plans in company history. And I didn't know what I was doing. And back in those days, you would open up the phone book and you would say, hey, point to somebody, and you give them a call and then hopefully do some insurance business with them. But that was years ago. I then got into wealth management. I actually, for many years, I had a international publication on personal finances and wrote two best-selling books back in the 90s. And then that kind of put me into working in the financial services industry at a greater extent. And really over time, just meeting a lot of people that were more on the trust side of the business, meaning structured trusts, what we call institutional. I just wrote a book. My latest book is called Hilton Wealth, and kind of about how they've built their wealth over time. But it's about the smart money. It's working with the folks. And I'm sure you've been in this area too, where you're around people that are the smartest of the smart people that are investing, that are kind of not on the retail level, but more in the institutional level. And so over time, got further into that. And here I am today. I'm partnered with the Hilton family, and that is the Hilton Hotel family, and doing several projects, and just excited for tomorrow.
Well, terrific. It's great to have you on the show. We're going to pick your brain and get into a lot of these nuances that make financial planning special. I noticed in your book, chapter one, it says the power of advanced tax planning. And that's intriguing when you think about that because the word advanced can be kind of two things. Is that like I'm going to do it proactively? Or
Yeah.
am I going to do it before the end of the tax season? And I suspect it's all of that. So maybe you could give us a little bit of insight as to what that book's all about.
So the book that I wrote before this most recent one, The Tax-Free Business Owner, just talks about the power of formalized tax planning, putting a formal plan together and going much, much deeper into the codes than your CPA could ever do. And the reason for that is most CPAs are designed, their firms are designed to do compliance work. That is tax preparation and then compliance for businesses. And, I always joke that the IRS calls it compliance for a reason. Uh, or else you'll end up somewhere you don't want to be, right?
Yeah, they want to catch you not doing it right.
Yes, absolutely. They want to catch you at something, and that's what really the most CPAs do, and it kind of irks me a little bit because that you would think in the modern era, kind of the information revolution that we're in and everything, CPAs would have kind of gotten the hint that they need to kind of get out of the 50s and the 60s, which they're still stuck in that model. And because they can make a fine living doing that. A lot of CPAs are fine with that. But when you think about it, aren't most people, and you've dealt with this, Ken, most people want to save as much as they can on their taxes, right? They want strategies to do that. And nowadays, the CPAs are just doing what they did back in the 50s and 60s and 70s and just preparing your taxes, giving you a couple things to do that are mundane, rote things. And they're not diving deep into the hundreds of other strategies they could be using to truly do what their clients expect them to do, save them the maximum that they can on their taxes.
Yeah. That really is a very good synopsis of what most all clients of wealth, those that really have their thought process is in wealth management and aspiring to continue on. I mean, the number one thing is preservation of capital. And the number two is that if you can reduce your tax burden, then you're well on your way to wealth management. You're well on your way to building wealth. And I think what's interesting is the tax code has gotten so complex
Uh-huh.
that for the vast majority of the brain power in the CPA offices, and we talk to a lot of CPAs each year and constantly collaborate with them, with their clients to help them to understand that taxes for next year happens right now. We're in the
Absolutely.
middle, we're in June, and no one's thinking about 2024 taxes. They're happily moving along, maybe taking trips and on autopilot. And advanced tax planning is in the here and now. And so when we think about proactively tax planning, then now's the time. And not only now, but how can I mitigate my taxes in 25, 6, 27,
Right.
28, 29? What path am I on for the taxes that and the tax burden that I'm going to have? And it's not necessarily thinking about it like, oh, I'm going to guesstimate taxes are going to be higher in the future, or what's going to be taxed differently. Are we going to have things like bonus depreciation and so on? Those are all helping kinds of things. But it's really a matter of looking at the entire part of a financial strategy and then implementing tax mitigation and tax strategies in there. So maybe you could take a moment and go inside the Hilton family strategies or any strategies that you want to talk about. But let's take a deeper dive into these tax strategies. What does it exactly mean to have a tax strategy from your world?
Well, again, it's all driven by a formalized plan. And you talked about, so we're ready for 25, 26, 27, a formalized plan sets that out long term. Every business owner has a business plan, but they don't think they should have a tax plan or don't know about a tax plan. I should say that. Their biggest expense that they're going to have in their entire lifetimes, their business and
Absolutely.
in their personal situation.
Mm-hmm.
What I always tell everyone is that it's first driven because everyone's situation is different from the plan, but we have some core base bulwark strategies that are like fringe benefit strategies that your business is doing. We could utilize accountability plans. We can utilize what's called the Augusta rule, which I'm sure that some of your listeners have heard of that. Basically, what you're doing is you're paying yourself back for the use of your home for the business using your home. That's an expense. We do kind of a deeper dive into some retirement strategies and make sure that people are using and focusing on proper strategies that are working on mitigating your taxes down the road, not ramping your tax bill up over time. And we might talk about Roth conversions to do that. We have some proprietary strategies. Of course, there's oil wells, but we also do a lot of work in the film industry. We also do a lot of mineral charitable work, leverage mineral charitable work. So I'm just throwing a vast array of things out here because the Hiltons have kind of been known in the institutional arena for being some of the best tax mitigation folks really in the world. And at this point, we have 130 plus tax mitigation strategies. And I would say probably 20 to 25 of those are proprietary to Hilton alone. So there's just the whole point here is there's a lot of things you can do. And I want to say something about a point that you made earlier about, the tax codes are so big. That's bad and it's good too. Because the reason it's good is because who made those codes? It's not some, pencil pushing guy with the green little visor on with a pencil in a room at the IRS. One guy. Congress is making those rules and is passing all those rules. And who are some of the wealthiest people in the world? They're in Congress. So they're making these strategies, and let's not pull the wool over our eyes, okay? And know that often many of them, the wealthy, know that they have control of the levers of power, and they can make tax code that, don't get me wrong, will help people too, but will also help scratch their backs. So there's a lot in the codes that can be dug out, a lot of loopholes, legal loopholes, by the way. Sometimes that word gets a bad rap. Mm-hmm. Legal loopholes and a lot of things in there that you can take advantage of that are put in there for a reason, and we want them in there. And if you're in the know and really know how to get at them and have the proper access, then you can take advantage of those things to reduce your taxes.
Yeah, I appreciate you circling back around that comment because it is a key, I think, to understanding why you want a collaboration, a family office kind of collaboration, because legal people need to be involved. The CPAs, the tax mitigation specialists need to be involved. Financial advisors need to be involved. Very often there are multiple steps that create an effective tax strategy. I think of like the Augusta rule. That's kind of low-hanging fruit. Everybody should be doing that. If it's the first time you're hearing that.
That's a strategy.
Yeah. Bulwark. I like that one.
Yeah.
So, we're going to go through that process, but we're also going to be looking at, are you going to sell something in the next few years? Are you going to buy something in the next few years? Then there may be a cost segregation strategy, or at the very least, we want to collaborate with experts to consider what all the options might look like. Legal people need to look at the kind of structure that you have, what corporation would be the appropriate one for you, and so on. And so when you have experts inside of a family office, ours is a virtually family office, and yours, I suspect, is also somewhat virtual. It's a virtual world these days, but many of your experts may be, in person in the office. And so all of that gets down to, as you said a moment ago, the biggest cost. And the way I say it is the biggest cost associated with growing wealth and taking income is the cost of taxes. And to ignore that creates an inefficiency that could cost you tens of thousands, hundreds of thousands, or tens of millions of dollars, depending on who you are and what circumstances are out there for you. So
absolutely. That's
I'll turn
great.
it back over to you now at this point and see what your comments are on that.
And absolutely, I will bring up a little story here of a client that I just brought on not long ago. And it's funny because you mentioned this, how things come around like this. Very, very wealthy guy, got very wealthy in the kind of the bathroom refinishing business and a bunch of franchises and so forth. And he was really glad to get with us because he was, something in his gut told him something was wrong and he was paying way too much in taxes.
I can do better, right?
Yes. He was like, there's something. And I think a lot of business people are like this. They just, they have that gut feeling. I had a gut before. I won't go into because we don't have time to kind of how I got into tax mitigation and all of that with the Hiltons especially. But I had this gut too that, hey, this isn't right. I mean, my taxes are going up massively every year. I'm doing better, but bigger and bigger and bigger chunks are coming out, and the IRS is becoming more part of my life, and all of this type of thing. So anyway, so we did a plan for him, and we saved him almost $1 million in his first year. We'll save him more as time goes on, and we talked about it because he's a very, very conservative guy. And literally, when we looked at his portfolio, he had millions and millions of dollars just sitting in cash, making like a quarter of 1% at the bank. And rightfully, he was a little concerned about that. He was like, "Hey, is this a bad thing? Because I got too much in cash." And I said, "Well, we kind of talked about it a little bit. Well, we just put $1 million in your pocket, okay?" And the way he was thinking, he was saying, well, I look at that as found money. That's my return on my millions of dollars that is sitting here in cash. Now, ultimately, we're going to put a plan for him together and make things work a little more efficiently, a lot more efficiently. But there was a great point that he saved so much money in taxes, it dwarfed what anything that he could have made on his portfolio. It absolutely dwarfed that. Okay. So it's a really cool thing to be able to do that and show people and put that money and that found money in their lap. And they're just like, flabbergasted that it was even possible and how they could even ever overpay that much on their taxes.
Right. I love the story. Yeah. It really, the rendition to that is that if you can save money in your portfolio, that's a return on your portfolio.
Very, very good point.
The more you can do that, the more you pay attention to the details, and the more that you collaborate with other individuals to help understand what your options are. And asking questions. And for us, I think in the advisory world, it's so important. It's a fiduciary responsibility that we have to collaborate with their other advisors. And frankly, if their other advisors aren't giving the kind of advice that's in their best interest, we need to recognize that as well and have those kinds of conversations with the client.
Tough conversations. Yeah.
They are, but it comes from a factual perspective of discussing with the client what their options are. Again, I call it education. It's not my opinion. If the numbers say a certain story, then it's a fact. It's not someone's opinion. And so we might have some conversation about how to get to those numbers, and
Right.
that's fair enough. And speaking of which, very often in our industry, what happens is that everything's focused on the stock market. And your previous client, I think, is a great example of somebody would say, wait a minute, I don't know about the stock market. And I've always said about the stock market, look, I love the stock market. Everybody loves the stock market when it goes up. It's like throwing a football. Three things can happen to you when you throw a football and two of them are bad. Right? It can be intercepted or it can be incomplete. So I call the incomplete being a flat market, intercepted being a down market. The only time it works is when it goes up. And you know what? We're hoping that it'll go up. And hope is not a strategy in my world. So very often what we'll do is we'll talk about the nuance between the public markets and the private markets, and how that works for a client. And I hear, anyway, the uber wealthy people take a big advantage of private markets in many different kinds of ways. So
Yes.
maybe you could expand on that a little bit in your world, because I know in my world, I like to allocate anywhere from 25 to 50% of an asset. And of course, there's a difference between the cash flow type assets, the long-term gain type assets. I mean, there's different strategies that way, but this is a conversation between, what the public markets can do and what the private markets can do. So maybe you could comment on that a bit for me.
Yeah. So in my book that's literally just released this week, we just hit Amazon #1 in the finance section. So
well,
we were
congratulations.
very happy about that.
Awesome.
Hilton Wealth, and I believe it should be published literally. I mean, that's it's Kindle and Audible and all of that. But it should be available on Amazon. But we can also get a complimentary copy from us. But what we talk about is the difference in how retail investors invest and how the smart money invests. Okay. And the wealthiest of the wealthy, you've heard the adage, the rich get richer. Okay. Very rarely, even strangely, oddly enough, when very wealthy people give their money away, and you and I kind of know why this is, Ken.
Yeah.
They get richer.
Yeah, it benefits them greatly, right?
But the rich get richer because they protect their wealth in very, very elegant ways that retail investors don't have available to them. So first and foremost is they're going to walk into a room, and when they look at an investment, they are going to be concerned. Warren Buffett's a perfect example of this. I want to know how my money's protected. Okay. I expect, because in that smart money arena, like you were talking about kind of earlier, kind of that area that is a little bit off limits, kind of off limits for the retail market, they expect there's going to be good returns. All right, because they're there. There's a lot of people doing amazing things in the private markets. Okay. So that's why they default, just like I work with all my Hilton partners and in the Hilton family, we default to security, what we call surety first. Okay. Mm-hmm. So we want to make sure that the vast majority of their portfolios, when I say vast majority, I mean at least probably 50 to 60% is ironclad. Okay. It has very little volatility. It makes good, solid returns, good, solid income. And then the rest, like you talked about, maybe we'll do equity markets. That's okay to do in smaller quantities, because over time we can do well, especially with institutional-based money managers. But then we have that sliver, like you had mentioned, that's the private equity. It's the availability to go directly into startup companies, or the ability to, like in the crypto space right now, where the Hiltons are working on a new fund but we're going to have some surety associated with it. So there's no chance of a data breach or something like that where people could lose their money. But it will be on the private equity side as opposed to the retail side. So the fees will be much lower and the returns will be much, much higher than they would be on the retail side. The big deal right now in the crypto space is the ETFs. Okay. Yeah, you pay a small fee, but that's basically just mimicking the indexes, mimicking the markets. What we're talking about doing is doing private equity, where some of the best in the entire world in the crypto space are able to trade in and out of different coins and make a boatload of money that comes back to the client. Different real estate offerings, going in unique kind of real estate offerings. We actually have, I mentioned on the tax mitigation side, we have some film offerings that bring your taxes down. But on the private equity side, we have film projects that allow you to participate in some of the biggest movies that are coming out via the Hilton Financial Network. So all these various things, and I kind of rambled on here a little bit, but all these various things are examples of being able to tap into private equity to bring your fees down significantly, but to have the opportunity in some cases to make, 25, 30, 40% per year on your money long term. Now, you don't want to take 50% of your money and put it in these areas, but it's what the wealthiest of the wealthiest do. And ironically, it's generally those private equities, private market areas are where the wealthiest make the most of their money over the generations.
Yeah. Yeah. I love that you go that way across so many spectrums, the film industry and crypto. And, look, those currencies, the crypto space is the future. We don't really understand that so much today, but being able to pay a small fee for the expertise to be able to structure what I sometimes call kind of a structured moonshot, if you will. I mean, to get these outsized returns, there's got to be something that drives that outsized return. And so to be able to pay the fee for the insight and the understanding of not where we're at now. It's like Wayne Gretzky. It's like I skate to where the puck's going to be. So very often when we're watching things like the public market and we're reacting to it day in and day out or any of that, that is not how to invest. But to be able to look at an opportunity and say, what will this look like in 3 years or 5 years or 10 years? And as Warren Buffett said, if you're not going to own a stock for a lifetime, you shouldn't own it for a day.
Wow.
Right. So the reality is that investments are for time. Mm-hmm. And time will help heal and grow and create those returns. Of course, there's income strategies as well. And so the flip side of that is that what are some of the precautions that we want to be thinking about, in terms of our investing strategies moving forward, and what things are the Hiltons, and by default you're thinking about in our near future? What are the bumps in the road? Where are our roadblocks?
Well, as far as income is concerned, one of the real advantages we have is actually to produce income on the private equity side also. Many of the companies we work with. And one of the things that we do, because the Hiltons are so, they're kind of, I'm not going to say risk averse, because they'll still take risk, but then they take very calculated risk, just like a Warren Buffett does, really. So one of the things that we generally do is when we go to an issuer, we'll say, hey, we would like to bring this on or have you or bring money to the table for you or something like that, but we need to have our surety. And usually what it will mean is we're only going to get to issuers that are open to put collateral forth of, either their own, put their money where their mouth is, or different collateral in their portfolios and all that. So a lot of times we'll have available to us high interest notes that are completely collateralized by like the full faith of the company or specific assets that they pledge towards those. And then we can get higher income, 8, 10, sometimes 12% on an annual basis. So that's one of the special things we do, because we do kind of have an income bucket that we want to see that's generally throwing that income out on a daily basis. Some other areas too is we have a lot of folks that are very, very interested, obviously on the real estate side, and by helping structure the safest type of real estate deals that we can on the private equity side, that we are reasonably sure are going to throw off solid income. Okay, even if we have a market downturn or something like that, that have a long history of being able to do that. So on the income side, that's primarily we tend to use, we like different types of annuities on the institutional side of the business that can pay 6-7% interest over time, and that they're safe and they're secure. We prefer that over the private equity markets, going to high yield bonds that have a tremendous amount of risk involved with them. So anyway, that's just some ideas, some things that we're kind of focused on right now.
Yeah. Yeah, no, that makes all the sense in the world. I kind of do that in reverse order. I mean, insurance companies are behemoth financial institutions. They have got legacy assets, been around for 50, 100
And they're
years.
all about cash.
Yep.
They're sitting on a lot of cash.
And very, very conservative, generally speaking, in the way that they manage their big pot of gold. And so therefore, they're able to take small numbers and turn it into pretty decent reliable income and pretty decent strategies, generally speaking. And again, the guarantees that you're talking about can be negotiated. And I suspect that when you go to those sponsors, like we do, we're looking for the sponsorship to say, hey, look, we are going to put 20% in, or we're going to have institutional investors investing right alongside our retail investors. And of course, I think the Hiltons would probably be considered more on the institutional class side, but my guys are going to be that $1 to $1 million class of person who is just as concerned about their assets. And when a sponsor can say, hey, look, we've got you exposed maybe 5 or 10% of the overall performance of this. We've got institutional investors that have invested in front of you, and their due diligence departments, their financial teams have vetted this. So this is an opportunity. The flip side, on the income side, geez, if you've got a sponsor that's got dividend coverage, as an example, that exceeds 3 to 5%, in some cases they're $7 to 1. You have to ask yourself, well, if they're making $7 and paying me 1, why can't I make more? Just take your cash flow and feel really, really good that you're sitting back in a very strong position. You sleep well at night, the cash is flowing, and your financial plan is working.
Yes.
And so it sounds like we're talking about the same conversation here.
Absolutely. And I mean, your point about helping, because I've been the manager of the Hilton family office for a number of years, and we're trying to rework a lot of things because it was a little bit dysfunctional before, and we're trying to get it more along the lines of virtual, like you've talked about, to find the best of the best to be able to come in and help. And Hilton Tax and Wealth Advisors is a spinoff company that I'm the CEO of, that we're very focused on. Me and Brad Hilton, who is my partner, is the grandson of Conrad Hilton. And we both have this passion, kind of sounds like you do too, to be able to bring these strategies a little more down to Main Street. It's interesting because a lot of the institutions and the issues that we talk to don't want to do that. Okay. And they're really missing the boat, especially in this day and age, because in the information revolution, people are getting much more plugged in, and the individual is getting more plugged in. A great example is this things that happen with GameStop and all of that, where people were getting where they can more individually realize that they can take advantage of these things. So that's kind of where we are. It sounds like you are too, Ken, that, hey, but so many of these bigger institutions still fight again. No, we want the 10 million and the 20 million at a time. Okay. That's much more efficient. Well, I don't think so. I think times are changing, and I think it's going to take a little bit of time, but it's about really having a passion for helping the people helping people truly invest, like the wealthiest of the wealthiest invest, and not just kind of throwing their money in a mutual fund and doing kind of the everyday retail things that people do.
Yeah, aligned right there with you. I believe in that 100%. I think there's a huge market of people that are worth $1 million to $5 million, right up to that qualified purchaser kind of range there. And
Right.
that may not mean a lot to a lot of people out there, but it sure does when regulators approve products and there's different kinds of barriers to entry there, and the ability to be able to structure these offerings for our clients that have 300,000, 500,000. But yeah, when you're thinking about that common person out there, we're talking about tens of millions of people that are called baby boomers and Gen Xers, and they've got a lot of money. And the other thing about it is that baby boomers' wealth is going to be inherited by the Gen Xers. So, I
Yep.
mean, there's a lot of money that's going to be flowing that needs to be taken care of.
Okay.
This little thing called inflation is just devastating to everyone, and it's a tax. It is just, but it acts so much more vicious than a
Yes,
tax.
because
And it,
it destroys everything around it.
yeah,
It really
yeah.
does.
When you model the effect of inflation, it is way more burdensome than taxes, and that's where we need to help. I think all investors to be able to get those kinds of returns that outpace this common problem that we all have called
Right.
inflation. And that again it's one of those things. Just recognize it as something that is necessary. And then when you've got, and I do too, you've got clients that are sitting on way too much money, whatever their numbers are. It could be $1 million to some people, it could be 300,000 to another. But when it's down there making just a few percent and not keeping pace with inflation,
Yeah. And
that
we
is a
we pray that, and this bout has lasted maybe a little longer than it should, but when you look at it all, I just heard, real inflation since 2021, maybe we've gone up 25, 30%. So everything's, 25, 30% more expensive than just a few years ago. So when we just hope that that rights itself, and we can get back to some normal levels of inflation, because this is unsustainable. If it continues to go higher, you're already hear about a lot of people that can't coming out of college and can't afford to, barely even rent, let alone buy a house. I mean, there's just a lot of devastating effects to inflation, and we hope, but we're optimistic, and we're thinking that this is going to get curbed and under control. We thought we had it under control, look like, and then it's kind of reared its head again. So we can get back to normal planning, right, Ken?
right,
Where we can
right.
plan for 2 or 3% inflation annually, as opposed to 15.
Yeah, those are really outsized challenges, and we do
Yes.
hope that it rights itself. But again, my thought process: the hope is not a strategy. So we've got to be thinking about more advanced conversations with our clients, squeezing out better returns without having to take higher risk, or at least being able to manage whatever that additional risk profile might look like. And that is the challenge, and I think that's why many investors out there, not just the uber wealthy, but the accredited investors, $1, $2, $3 million, they really need advanced planning and they need professional help to have the conversations to educate them on what those opportunities look like.
That's right.
Well, time for final thoughts. Mark, any final thoughts for our audience?
Well, I just think it's important for people to be educated about that there is other ways to invest, and what we believe is better ways to invest out there. Brad Hilton and I do through Hilton Tax and Wealth Advisors. If people would like to get in one of my books, either the Tax-Free Business Owner or Hilton Wealth that has just come out, they can go to our website, which is hiltonwealth.com, hiltonwealth.com. If there's not a pop-up or something there, you could just send us a note and say, I'd like a book. We'd be happy to send it to you complimentary. And, I think people just really need to be educated and kind of find out and learn, the old adage that you don't know what you don't know until you know it.
Mm-hmm.
So just get themselves educated to realize there's better options, and I think there's better ways to build your wealth over time.
Yeah, absolutely. And that's the whole theme of our podcast really is to help bring some value to the listening audience out there, to help provoke maybe some thought processes, and to give some hope that there is professional advice out there, fiduciary professional advice where you can tap into those that are interested in your well-being, and not because it's an opinion, because we can help educate and provide information to put you in a position for you to make an informed decision and move forward with that. So again, Mark Miller, thank you so much for your time today, and go on his website and find his book, his latest book. And then, of course, Amazon is where I found his existing book. And so great stuff there. Tune into our website also at www.pinnaclequiz.com. And we'll provide you with free downloadable PDF containing 10 pieces of planning retirement advice that retirees wish they'd known before they retired. So again, that's www.pinnacle, Pinnacle, quiz, Quiz.com, and get your free downloadable 10-piece planning retirement that will answer questions that you wish you would have asked before you retired. So any final thoughts at all, Mark? We're done for today.
No, just thank you so much for having me, Ken. And I think we've covered a lot of ground, and hopefully we gave all your listeners some great information.
Oh, yeah. No, again, the key thing is get the information, share it with your other professionals, take our quiz, reach out, get Mark's book, read his book, educate yourself. You'll know when you're making the right decisions. Thank you, everyone, for your time today.
And listeners, remember to follow this podcast, Proactive Tax Strategies, to know when a new episode is ready for you, and of course, share with others. Thanks for being with us.